I also try to invest in companies that I can literally just hold, even if we go through like a nuclear attack. Like I just emotionally, emotionally, I'm saying like I only bring that up because Manish Pabrai, a famous value investor, talks about which companies could survive a nuclear attack, like just as a thought experiment, and he brought up Coca-Cola as an example because you could just hide the ingredients in a vault and just like over time
but
people
dude,
are
you invest in Open Door and shit like this. Like,
hold
what are you
on,
talking
but
about?
Hey, Tevis, you're the host, right? Can you show some fucking excitement and some energy for this podcast, please?
This is the highest my decibel will go in terms of level of excitement, all right?
Goodness gracious. You're supposed to be like, welcome back, everybody. It's another Friday, SoFi week. You're over here like,
How do you do that on command? It's so animated.
Yeah, so I mean, oh, yeah. He is a robot.
Michael, who the hell are you?
By trade, a chemical engineer. I work for Anheuser-Busch, and I love to invest in stocks, pay attention to stocks, follow great companies, and also invest in real estate. And SoFi is my largest investment in my personal portfolio, so that's probably why y'all wanted me on.
What percentage of your portfolio is in SoFi?
Yeah, if we include overall picture, which would include my 401k, it's probably about 50%. And if we take out the 401k, we're probably at about 97% of my overall portfolio.
Just 97? You gotta
just
pump
97. I've got
man.
3% Palantir. You know, we're building that up, but yeah, just 97 for now.
What was the first decision that made you want to invest into SoFi? Like what started this whole process of you going down the SoFi rabbit hole?
First of all, I'd never heard of SoFi until the SPAC craze. Like when the SPAC craze hit was when I found out about SoFi and started kind of researching. But I became a customer of SoFi in June 2021. Almost immediately switched everything to SoFi: direct deposit, Roth IRA, standard brokerage accounts. I got away from Mint and started using Relay. Pretty much very quickly fell in love with the product. And I think the biggest thing that I liked about it was the ability to dollar cost average, the daily buys, and frankly, the interest rate. I just started by buying, a few shares here and there. And then as the stock dropped, I just kept throwing money at it. When Noto started buying in December, I decided to essentially double my targeted shares. And so I followed suit and started just throwing money at it when he was back in December. And I don't have the credit card yet. To be honest, I'm waiting for better credit cards. I use a Bank of America Visa at the moment. It's just a cash rewards card. I like being able to change what I get cash back on. So theirs is just a standard like 3%, 2%, 1% structure. So I'm kind of waiting for some, I think, better products from SoFi before I get that credit card. And this would be the first debt product that I would have via SoFi if I go through with it.
Relay is the fastest growing product at SoFi right now. How does it compare to a Mint?
I think they're pretty similar. To be honest, I think Mint has a little bit more than what Relay has. But what I'll say is Relay's ability to then connect with everything else is what sold it for me. To not have to go to another app or another website or another company to do all the same financial things, that's what sold it. And I think that they'll continue to improve Relay over time. And actually, they have. The user interface has gotten better since I first joined.
You said you're a product guy and you transitioned everything onto SoFi. If you had to narrow down sort of one key product insight that's their strongest, and then one opportunity, let's say something that's their weakest, and then where is an interesting area that you think they can develop from a product perspective solely?
As far as their strongest suit, I'd say banking is probably the best though. The early paycheck is cool. The APY, getting those notifications that you got that interest rate or that payment into your account is awesome. And all just the electronic features they have with banking is pretty incredible. I have used ATMs via SoFi. That's somewhat weird because typically those ATMs that you have access to are either in a gas station or a convenience store, a Walgreens, something like that, which is something I've had to get used to, as opposed to showing up to a Chase and it's a Chase ATM. As far as biggest opportunities, and I just have recent experience with this, I actually just applied for a pre-approval for a mortgage via SoFi, did it all through the app. And for the most part, it was a good experience, but I think they can get better with integrations with the rest of the app. When you fill out a application for a mortgage, they're asking you things like, what is your income? What are your assets like? Where do you have liquidity? Where do you not have liquidity, etc. And it was not tied in at all to Relay, which was a disappointment for me. I would think that with everything being tied in electronically to Relay, SoFi would already have that information and they could pre-fill it out for me. That was not my experience. So I think they can improve that. What was good about the mortgage application, however, is once I had it filled out, I had a pre-approval letter literally within seconds and did not have to interface with a person at all. It was all done electronically. There is someone I have a contact with, but I haven't had to really talked to that person at all so far.
What do you want to see from SoFi going forward?
I think the biggest thing they need to focus on right now is the user interface on the app. And that's really what sucks people in. And if back to the whole point about Relay being a free way to bring customers into the ecosystem, well, if they have a great experience on Relay, which I think it makes sense that they are focusing a lot on that part of the user interface, well, then you're going to want those other products. But those other products need to follow suit quickly. Otherwise, you're going to be disappointed that Relay is pretty cool and then the other products is maybe lagging behind.
It's actually really interesting, Michael, just to hear your perspective on a lot of these things, because it validates what we've also been seeing on our end. You know, one of the things that we've been saying, and I see Riley smiling, is 2023 credit cards has a lot of room to grow. And then from an app perspective, you're like, okay, well, the UI is definitely their lowest hanging fruit in terms of what they can fix. And so it's just nice in my mind because it validates that what we're talking about from a problem perspective is actually legitimate and shared by the entire SoFi community. And we're not alone in that thought.
I think SoFi's main problem is a problem of being able to get the product in front of enough people. So it's almost similar, not that they have an issue with supply chain because it's a digital app or a website, but their reach is kind of their limit, if that makes sense. So for however many dollars they put behind that reach is going to directly translate to their growth. And I think their growth is almost intentionally limited. I mean, if you've listened to the earnings calls, you've heard Noto talk about a target of 400,000 per quarter as far as new member ads. I think that's very strategic because they have a very particular client base that they're going after. And in the meantime, they're focused on the under the hood back end things, which is probably why, in my opinion, the stock is so misunderstood. It's misunderstood, but Noto is focusing on the right things that take time. In today's day and age, everyone wants results tomorrow. What he's focused on to integrate Technisys with Leo with SoFi Bank. If you've worked in big corporate, you understand these things, they just take time to integrate. And I think he's focused in the right areas.
Big piece of news this week, SoFi reached out to debit card holders saying that on February 28th, late next week, they're going to be changing the issuing bank for debit cards from the Bancorp bank to SoFi Bank. Obviously, this is a pretty big positive change because it really points us in the same direction that we've been talking about for SoFi going all in-house with regards to their cores, having that vertical integration and continuing to have the flywheel effects that are only available when they're a full end-to-end provider of their services and are not reliant on third parties.
Pretty exciting. If you guys don't know the full potential of what this is,
To me, it seemed like a nothing burger, but I guess it's not a nothing burger.
there's a lot of different players to make the full payment network here. What we're looking at is the issuing bank section of the process. Before was the Bancorp Bank, which should not be confused with the US Bancorp. Me and Tevis had done more research into. It's a really tiny bank that pretty much takes control of actually designing and sending out those cards for us and literally distributing the cards. What this pretty much means is that, one, we needed to be a chartered bank to do this, and two, we actually needed to have great technology in place to be able to do what the Bancorp Bank could actually do previously. That's probably because the core that we run our deposit and our debit cards on is now on Technisys. This is large cost savings for us. We're able to get away from the fees that we were paying to the Bancorp Bank, just a little bit more in-house, which we've seen from times that we haven't been on these sorts of systems. Sometimes these partners have failed us. So we're owning this system ourselves. We're lowering the fees. And then not only this, Amit, now we can go to all the other customers, the Chimes, the Robinhoods, these sorts of customers that are also using the Bancorp Bank and say, you're already Galileo clients. You're already the issuer processor clients. We're offering you the cloud native experience through Technisys. And now we can also be the issuing banks of the actual cards. We'll send out the Robinhood card to the client. We'll do all of this. We're going to take a small little fee, but we'll bundle it as part of the AWS of fintech.
The silver lining is we used to pay somebody else for the service, and now we're doing it all in-house. And the more that we do that, the more that we're going to save money on doing all this stuff ourselves. And whenever we have everything under our own umbrella, we're going to be able to build really cool stuff on top of it.
It's important to know that there's a lot of chartered banks, fully licensed banks that still go out of their way to have a company that specializes in this, like Sutton Bank, like Stride Bank, like the Bancorp Bank, to still manage those processes because maybe they've already have the technology and the innovation to actually do that at a more scalable level. Obviously, if we are making this jump, it's because they've discovered some way that it is going to save on costs or it is going to make this product more effective, or else we wouldn't have made the jump. We also have a relationship with a different issuing bank for our credit cards. We deal with the Bank of Missouri for our credit card processing. Technically, our deposit accounts and our credit cards are two different cores. But as we actually start to develop that one core system that we're expecting for Technisys, we'll also probably leave the Bank of Missouri as well. And then that same sort of funnel of what Michael wants to see, new premium credit cards for him to switch off of Bank of America, it might need to be in SoFi's hands so then they can lower those fees and give more of that back to the customer.
Do you think this is also part of their attempt to become gap profitable, like finding as many different ways to reduce costs?
Absolutely, Amit. Like I love the way you're thinking about it, because they wouldn't have made the change if it was not a good move for them to do. Like logically, that makes sense. But the cool thing is, and just to double tap on a couple of things that Tannor said, they have both B2B and B2C tailwinds off of this. Because from a B2B perspective, it's going to be very hard or next to impossible to, in the future, let's say, find an issuing bank for debit, an issuing bank for credit, as well as the same entity or the same organization to offer all of the services that Galileo offers, because you usually get one or the other. And so whether you like it or not, you're cornered into having multiple suppliers for multiple different things and having a fragmented experience where your systems don't really talk to each other. The value proposition for SoFi B2B after consolidating, of course, is going to help them with more efficiency and more savings from what they offer to their end consumers, B2C. So in terms of the fees, we might see better rates. We might see better SoFi Plus membership benefits as a result of them being consolidated. But it creates a competitive moat on the B2B side, because it just diversifies their offering in such a way that no other businesses can really compete, because you don't have chartered banks offering what Galileo offers and vice versa.
If you go ahead and Google this and you see the amount of issuing banks, you'll see a list, okay? A long, long, long list. Issuer processors, a long, long list. Then you type in issuer processors and issuing banks, the list gets very small. It's not down to SoFi only, but then once you add in that cloud native banking core process as well, then that's where the search result comes back as one name. And that's what's really exciting, is that where's the moat is always the uninformed one-liner that people like to give, but that will be the moat. Having this bundle allows us to beat out the competition the same way Microsoft beats out Zoom with, offering Teams at such a low fee and everything like this, just because that's not where the profit is. They're pushing profit elsewhere, and that sort of bundling, monopoly is unfair. But I like to own the companies that have that unfair advantage.
100%. And I think, just to expand on that, the vertical integration, obviously they would have not done if it didn't make sense financially. So that's why I said earlier that Noto's focused in the right areas strategically. Bringing up the B2B is spot on, because let's not forget about the small banks that rely on these other issuers. And now SoFi is able to come in and present that you don't need to go to multiple people. You can just work with us. As long as they're able to build that trust with these businesses, which again, Noto's talked about in earnings calls, he's going after a large client or clients, but also these small regional banks are going to be absolutely critical to, I think, SoFi's success and their strategy. These banks have to update their systems, and there are certain customers that just will not switch to digital only. And this is how SoFi accesses those customers and gets interchange fees, etc. So you can actually get the best of both. You can be the best product and cheaper, because you have that one-stop shop. And that's something that only companies who vertically integrate and have something like that are able to do.
We can find hundreds, if not thousands, of new customers that have had no system like this at all. And we sell them almost a digital product that needs no customization. It's sort of the Lego-like pick tier A, tier B, or tier C. With our larger clients, we can literally have full teams work with them. And I think that's really what's going on with Galileo right now with large banks. They're talking about a long sales process. But for the small regional banks, it will be potentially a single day sales process.
Let's not forget, let's think about these regional banks, these credit unions. Think about who runs those. These aren't necessarily people who are on the cutting edge of technology. So if you come to them and say, hey, you need to update your website and you need to get relevant, there's going to be a lot of initial concern, pushback, hesitation. But if you're able to come in and say, we are the one-stop shop, you don't have to work with us and then work with someone else, and it's fragmented and here's a PowerPoint I'm going to sell you. It's no, here's actually how the system works and what we can do for you. That's your foot in the door, that competitive advantage. I don't see other companies having.
Michael, I was going to ask, do you have your money in SoFi Bank or it's still in a different bank?
Vast majority of my funds that are liquid are in SoFi Bank. I'll expand on that too. So I have real estate investments. My business account for real estate investments is through Chase. Chase's APY is terrible. The only reason it's through Chase is because SoFi doesn't offer business accounts yet. But what I did was I actually set up a vault within my SoFi savings account and just titled it real estate. So the funds would not be commingled. And I would be able to say, okay, this is the real estate funds. This is my just normal funds. That way I could take advantage of the APY. So I actually pulled money out of Chase, transferred it all, of course, electronically into SoFi. That money now became part of the flight away from legacy banks and into SoFi, chasing the APY. And then anytime I need it back in the Chase account, of course, it's just another digital transfer back.
Your real estate LLC and that you use business expenses, all that stuff, all of that you can still do even if the money's not literally in the Chase account the whole time.
You do have to be a little bit careful with real estate investments or any LLC when you do commingle funds. So this is something you have to watch and be careful. It's, basically buyer beware. It was a risk I was willing to take to capitalize on that APY. Right now I only have 6 units, 3 properties. If that was 10x larger than that, I might take a different approach and leave it in Chase. But again, it was a risk I was willing to take. And I think a lot of smaller landlords like myself would be willing to take. And that's just another opportunity for SoFi. Noto has said we will go after that when the time is right.
Yeah, if they make a business account, I'll go from Bank of America to SoFi immediately. I guess there's a question for the panel. When do you think we get the SoFi business account, and is there a regulation or legal thing stopping it from coming out?
There's 4 things that Noto has told us in September, early September, when he was at a conference talking about what we're doing to transfer off of our modern core or onto our modern core. And we're trying to replace lending, checking and savings, which recently we got proof that Tevis talked about, and that's the debit card. Switching over to SoFi Bank. Credit cards are going to be moving on to our own modernized core, and then the invest product. Those 4 things are the only things holding back SoFi from being a fully vertically integrated app.
Noto has said that they will be fully migrated onto their own cores by 2025. That's the number to keep in mind. Credit cards is feasibly going to be next, and then the invest product after that. So in 2 years, it's all in-house if we keep to their timelines. And they haven't missed timelines so far, so I don't doubting what they're saying.
Michael, you've been a SoFi member since 2021, and you probably have been frustrated and wanting the app to actually improve. What things would you like the app to become, like in the future after we're fully on our own core?
And what I want to see the user interface just get more smooth and faster and snappier. And then after that, I think, Riley, you had some awesome ideas on control. And what I mean by that is, so let's think about Relay. Relay right now is a lot of just monitoring. I'd like to go a step further and expanding on what your idea was. Let's have control over things like subscriptions. Let me, within the SoFi app, not even leave the app, not have to go to the website, turn on and off my Netflix subscription, my Hulu, my whatever it is within SoFi. Now, obviously that's going to take some, technical back end things for them to do. But if they're able to do that and continue to expand that, I think that they have a product that no one can catch up to.
Another angle to look at it for what is the incremental benefit after SoFi having everything in-house, in my mind, from a user perspective, will really be SoFi Plus. We were just talking earlier about just one thing moving in-house, which is checking, and all of the different sides or synergies that we could see in the next coming months as a result of this consolidation. Imagine now if everything was in-house, what that SoFi Plus core could become in terms of not only the cross-selling, but also the different promotions that they can have within the benefits portion of SoFi Plus. And so I just think that once everything is in-house, SoFi is no longer dependent on anybody else externally, and they can really bump up the benefits of SoFi Plus. It just becomes a game of what is their customer acquisition cost, what is their lifetime value, and how can we optimize that equation? Because you don't have any more dependencies.
And something I think in this new kind of digital era with banks that every bank should be worried about is how easy it is to have a run on a bank now. If let's say Chase comes out and does something that upsets their customers and people all of a sudden want to boycott Chase. Well, back in the day, it was kind of difficult to boycott Chase. You have to go down to the bank, pull out physical cash, move it, maybe write a check. It takes 3 business days, sometimes longer, whatever. Now you hop on your phone and you yank your money out of that account and put it somewhere else. To you and I, that's just a transaction you do on your phone. To the bank, that's a big deal. they're having a run on their bank. So there has to be something that keeps that moat and makes it a sticky product that you don't want to. Number one, you have to gain and keep that trust. You can't have a moment where you lose it and make people want to boycott you. I think Noto's done a good job of that and will continue to. He's got the right mindset as far as being customer centric, customer focused. Everything they do is kind of like that Amazon mindset. The customer's the boss. That's a great way to be. And then two, if you've got everything with them, it does become kind of sticky because it's not as simple as just pull your money out of the account. It's, well, I've got my mortgage with them, I've got Relay set up, I've got my investment accounts with them, and that is the difference. I think legacy banks ought to be very concerned about how easy it is to yank your money from those banks now.
Even speaking on that with Galileo, they came out recently with a product called a direct deposit switch, which is making it, I think their term was 50% more effective for people just to be able to change their direct deposit. And that's not just for SoFi, that's for all the clients that actually end up switching with that. So that could be the legacy banks as well. That still puts Galileo leagues above the other products, because a direct deposit client is worth 6 to 10x more than a regular just depositing client. These banks aren't even trying to grow necessarily customer counts and deposits or anything. They're really just focusing on return of equity and the overall shareholder return.
One interesting thing happened this week we haven't talked about yet because it doesn't necessarily pertain to SoFi the company, but more so SoFi the stock. Generally, we tend to shy away from those conversations because we're all fairly long-term oriented and not planning to sell or trade SoFi anytime soon. But with that said, I thought it was interesting, Michael, especially because I see a lot of your valuable content on Twitter, which is technical analysis. You posted as well this week about a golden cross. Yeah. So let me see if I can explain it, and then Michael, just keep me honest. So basically, a golden cross and a death cross are two opposite things. And it's basically when the 50-day moving average crosses the 200-day moving average, I want to say.
The direction of the cross is what defines which one it is. And to be clear, it hasn't happened just yet, right? It looks like it's going to happen here in the next couple days.
The blue line is the moving average. So basically what that means is it's the average of the last 50 days. And then the red line is 100 days, which we can ignore for now. The pink line is 200 days. So the average over the last 200 days is SoFi stock has been trending down, obviously, because, it's been trending down. But in the last 50 days, you can see this move up, which was backed up by earnings. And so in the last 50 days, it's moving up. And so this right here is what the golden cross is when this blue line crosses over this pink line, which would signal a very strong momentum in the short term. And that's an incredibly bullish thing. A death cross, by contrast, would be if it's the other way around. If the blue line was above the pink line and it goes below it, would signal a very negative. So for example, this right here is a death cross and the stock falls. But the reason why I liked this in particular, when I don't really follow technical analysis, is because these generally take a long time to materialize. This is a daily chart, of course. So this is months and months and months. I mean, back here is December. So they take months to form. And usually when they do, they show a longer trajectory of momentum up or down. So it's not like an intraday signal or something like that. It's more so a long-term technical signal.
You see, we're coming up on a golden cross. You look at the volume, and that was, of course, backed up by the earnings. But if you look at the volume of buys when we had the breakout, essentially, and we finally got up above that 200-day moving average, a large volume breakout is significant. That's a big deal. If you look at more recently, we've consolidated. We're pulling back. I would call that a bull flag. Let's see. But that's been done on lower volume. That's exactly what you want to see with a momentum shift. So now you've just got less people kind of trading. The broad market's been pulling back. We all know that. So I don't put a whole lot of stock in, what's happened more recently after those earnings. Doesn't matter as much. And you hit the nail on the head. Short term, the stock market is a voting machine. Long term, it's a weighing machine. And so short term, something like a golden cross tells us where people are voting. But if you also look at that kind of consolidation period when we're in the low fours, let's remind ourselves that's when the CEO is buying the stock itself. Looks like he maybe nailed the bottom. That is exactly what you see on a reversal. Now, one thing to keep in mind is the overall broad market is very shaky right now and is actually coming up on potentially a death cross. I think it was on the weekly, if I remember correctly. The NASDAQ is potentially seeing a death cross. So that's going to be a lot of weight. But SoFi can just stagnate. We've got the 200-day starting to flatline. We're going to have a golden cross. I'm okay with sideways movement while the rest of the market figures itself out. And frankly, I'm even okay if it continues downward and falls below the 200-day, comes back above. Again, just choppy sideways movement. To me, that is just like a loaded spring. And we continue to coil it up and coil it up. When the market figures itself out, this will rocket, which is why I think technical analysis can just be part of a more broad assessment on what a stock and a company is doing. It does not replace fundamentally what a company is doing, but it's a good way to understand how the market's voting and where people are seeing things. So yeah, I think we're in a great spot. Like I said, I'm okay with choppy sideways movement for a while. The 2020 and 2021 market broke a lot of people of what investing is really all about. And frankly, a lot of people just started investing during that market. So they think it's all about, meme stocks and short squeezes and buying options and things like that. Very, very few people build wealth doing that. Some people do, but very few. And over time, the people who really build wealth are the ones that buy good companies and just wait.
Yeah.
Yeah, that's sort of why I don't look into technical analysis too much.
I don't necessarily trade on the technicals. I might use technicals to time entries intraday, but that's just penny pinching at that point. On a more holistic level, why it works is because it's psychology, right? Like if something happens repetitively, then people start to expect that same action. And that's why technical analysis is even a field. I'm obviously oversimplifying it, but if nobody believed in a golden cross or death cross, they would not be a thing. And so they are a thing because of the consistency of them actually coming true, because it becomes a self-fulfilling prophecy. When we say, oh, golden cross, let me buy right now before it crosses, what's going to happen? It's going to cross and actually go higher. So to some extent, technical analysis is just psychology simplified.
Yeah, and it also kind of tells a story. Like if you look at when that death cross happened and then the stock just got pummeled along with the rest of the broad market, it was brought down with the SPAC craze, etc. Now we've been able to find a bottom, consolidate, and basically the market was able to find kind of a fair price. What was the market willing to pay for SoFi? 100%.
Just watch the SoFi Weekly. Yeah,
the right
yeah.
comment.
And you'd be down pretty good on your investment year to date, or what?
This is why we're not financial advisors.
As I was applying for that mortgage via SoFi's app, they had 3 different options that I could choose from as far as, do I want to minimize how much money I have to put down and pay a higher interest rate? So basically SoFi makes it back on the back end. Do I want kind of a more standard mortgage where I, don't really pay any points, or I pay a minimal amount of points and kind of get an average interest rate? Or do I want the lowest interest rate and I can pay points? There was actually an option where I would get thousands of dollars back from SoFi when I got that mortgage. So it would come out of what I put in my, now that's not my down payment. That's money coming from SoFi. They're actually paying me essentially a rebate for me to then agree to a higher interest rate than what the prevailing interest rate is. Now, you might ask, why would you do that? Well, you would do something like that if you're going to only hold that mortgage for a very short amount of time. You're only going to keep it for 5 years. You're willing to pay a higher interest rate now, and you want them to pay you points. On the flip side, if you think I'm going to buy and keep this house 10, 20, 30 years and actually pay off the mortgage, well, then it makes more sense to pay the points up front, get a lower interest rate. That's a pretty cool feature. It's a pretty cool option. I've not seen that with other banks. And just to have that ease of being able to do it right on my phone. I'm not on the phone with a 9-to-5 banker that I have to, get out of work or take a lunch to call. It's an option I just have right there.
Man, I'm so excited to see how that home loan segment develops as the year goes on. I mean, it was stagnant for so long, and now they're just hustling back now that they actually have fast-tracked a new partner. First of all, I want to know who that partner is, selfishly, just so that we can do some mental math to see whether it is a bio candidate. My bet is definitely that it will be. I think I mentioned this in a previous SoFi Weekly, but home loans and student loans, they're a complete write-off from the market's perspective for this year. And so that segment, actually having some more details around it in Q2 and Q3, has a real opportunity to delight to the upside for the entire market's expectations.
What are your all thoughts on student loans in the news that has come out as far as Biden's new plan to potentially reduce or circumvent what the Supreme Court may end up deciding and shooting down the actual forgiveness?
Well, so I think there's 2 parts there, right? Okay, so number one is what happens with forgiveness and how much does that correlate with them actually stopping the resumption of student loans or extending that moratorium for longer. And I don't think that those things are so correlated, right? I think that there is a world where a happy medium can occur where they say, hey, we're not going to approve the forgiveness, but we are going to resume the student loans, which is a middle ground. But for us, resuming student loans is all we really care about, less so than the forgiveness, because our demographic doesn't fit the mold for somebody who would be forgiven. And then the other part of it is, I'm not sure that it is in Biden's hands anymore, right? I mean, we don't usually get into heavy politics on the pod, but I think that now that it's in the Supreme Court's hands, there is a natural timeline where these things will happen. And sure, it might get pushed back a bunch, but there is a foreseeable end to this. It's not necessarily going to get pushed out like 11 times.
Yeah, I'll have to look up the exact numbers, but essentially his new plan is, okay, if forgiveness itself does not come to fruition, which the Supreme Court is relatively packed conservative, it's likely they're going to shoot it down, in my opinion. His new plan is, and it's actually, I think, a better plan anyways. There's currently a cap, depending on how much income you make. If you're under a certain level of income annually, there's a cap on how much of a percentage of your income you have to contribute towards your student loans. It lowers that cap. I'm pretty certain it cuts it in half. Now, that's a particular demographic, and you hit the nail on the head. That is not the demographic SoFi is going after. When SoFi advertises and I see their student loan advertisements all the time on Instagram, which is hilarious because they're targeting the wrong person. But for medical students, they're always, hey, you've got medical student loans, come to SoFi. That's who they're going after. Those folks aren't what Biden's plan is about, anyways. They're well above that cap, well above that cap. So I actually think his new plan is something I can get on board with. And I couldn't really get on board with just a blanket, let's forgive this one and done that is very selective to a particular group of people. And it's just a weird setup. I actually think the new setup is better. And to your point, does not impact SoFi's demographic. And what we can come out of this with is hopefully resumption of the payments and people that actually want to then go refinance. I actually work with people who have said, yeah, I've got student loans. The payments are on pause. I've got money sitting in the bank to pay them off. But why would I pay them off? Like, I'm just going to wait till they come back and then I'll pay them. And so that's going to be, I think, a huge tailwind for SoFi.
On Tuesday is when the Supreme Court will hear the legal challenges of Biden's administration around student loan forgiveness. So we knew that the process was going to start in the end of February. That's actually going to be starting officially on Tuesday.
It will be interesting to see how long it takes for them to come to a decision.
Oh, well, I think it's going to get extended. It's probably going to take way too long.
I think regardless, though, delayed or not, it's a tailwind for SoFi. I see in this.
February 28th is the same day as when the Senate hearing will hear the Supreme Court. This is where CFO Chris Lapointe will have a fireside chat in the KBW Fintech Payments Conference. And then on March 21st, we have a Bank of America Electronic Payments Symposium with CEO Anthony Noto being in that fireside chat. Every single time we have these chats with the SoFi executives, we tend to generally get tidbits of the latest updates around where they are in terms of their development.
I'd love to talk about some potential other fintechs, how they compare to SoFi. Block is a really, really interesting one that just announced. Their growth rate expected at Cash App is going to be absolutely insane. Nubank, they're SoFi in Latin America. They're taking on the exact same path of doing everything all in one roof. I'd love to hear why Riley saw my latest SoFi versus Nubank video, but yet he said he doesn't like it.
Nubank, I just don't know enough. I feel like there's so many external factors that I don't understand when it comes to that company in particular, that maybe it is a good investment, but it's not a good investment for me.
On that same vein, Buffett had this really famous quote where he said, you should only be buying companies that if the stock market closed tomorrow and was closed for the next 10 years, you would still be comfortable holding. Companies whom you're comfortable, you can sleep easy at night, holding them for a long period of time when you physically cannot sell out of that position. Nubank has some aggressive growth numbers, far exceeding even SoFi. The reason why I personally wouldn't touch it is that same concept where if I invest in Nubank, I'm investing in Latin America. And is that an investment I want to make?
What I saw and what stood out to me, one, I like Nubank. It would make sense as a broader part of a diversified portfolio, which obviously I don't have in banking. What I would say that the reason I like SoFi more is somewhat touching on what Riley said. One, I'm a customer of theirs and I really like it. But two, it's the target audience. Nubank has a massive user base, which is good. But if you look at that user base compared to SoFi's, profit per customer for SoFi is substantially higher. And it's because they're playing in a completely different league. To be clear, I like Nubank. I just like SoFi more.
If we look at Q1 of 2022, SoFi's revenue was about 330 million. Back in Q2 of 2021 for Nubank, they were at 336 million. So quite similar. The next quarter, Nubank went up by 43% to $480 million. This continued all the way up to 1.4 billion. SoFi still hasn't even hit the next quarter. It'll take them a year plus. And they're not even guiding for that, by the way. They're guiding for like 423 million. All I'm saying is this growth rate is insane. The average revenue per member, like you said, much different of a story. But back in Q2 2021, SoFi made about $90 per member, and that's actually gone down to 87 per member. The opposite is true for Nubank. $8 in Q2 of 2021, up to $20. Nubank is much riskier in terms of things that we can't measure, international risks, potentially what happens with inflation there. All the credit products would die if something like Argentina happened where inflation rates went up to 100%. So that is really, really scary. But if you're talking about growth rates, there's not even a story here.
If you're not following this channel, sometimes periodically, we will have SoFi Weekly on this channel in addition to Tannor's or Amit's. So definitely subscribe to the channel. Yeah, fair enough.
Yeah, for sure. Hey, I'll just say real quick, thank you for having me on. I appreciate it. And thank you for everyone that's watching. And if you follow me, it's not just SoFi. I talk a lot about other stocks as well and real estate. Those things are my passions. So appreciate anyone who does.
Great place to end it. Thanks, everybody. See you next week for another episode of SoFi Weekly.